Hey everyone, in today's video, we're going to be tackling a topic that a lot of people have to deal with when they're easing into retirement, and that's how depreciation affects your rental properties when you sell them and how you can minimize those taxes now and in the future. So if you own rental properties or you plan to sell them prior to retirement, stay tuned to learn how to calculate taxes, avoid depreciation recapture, and also explore some strategies to reduce your tax bill overall. So the first thing we're going to do is we have to figure out how to calculate your accumulated depreciation. So first thing you need to do is calculate how much depreciation has reduced your property's basis, meaning the original purchase price plus any improvements that you've made to the house. This is going to lower the amount of gain you'll be taxed on when you sell. Step two is you need to understand your tax basis. So this is the original price plus improvements minus the depreciation you've claimed. This is what you'll use to calculate your taxable gain when you sell. Step three, you're going to calculate the gain on the sale. So when you sell the property, the taxable gain is the difference between the sales price and the adjusted tax basis. So take the original purchase price and subtract any depreciation, and that's going to give you the gain. Here's where it gets tricky. So depreciation recapture, what this means is the IRS taxes the depreciation you claimed at a higher rate. So currently that rate is 25% here in 2025. So this will apply to the portion of your gain tied to depreciation. Step five, you're going to calculate the capital gains tax. So any gain that exceeds depreciation recapture will be taxed at the regular capital gains rate. So this is going to depend on your income and your filing status, but in general, the tax rates are 0, 15, and 20%. Step six is you're going to calculate the net proceeds. So once you've calculated the taxes, you can determine your net proceeds. So that's the amount you're actually going to get from the sale after taxes are deducted. So let's run through an example. Let's say you sold a property for $390,000. And let's say you originally bought the property for $105,000. And let's say after 11 years, you've depreciated roughly $42,000 on that property. So your adjusted tax basis is $63,000. That leaves you with a total gain of $327,000. So the depreciation recapture would be taxed at 25%, meaning you would owe $10,500. The remaining gain of $285,000 will be taxed roughly 15%, which comes out to $42,750 in capital gains tax. So in total, you'll owe $53,250 in taxes if you were to sell that property. You might be thinking, well, there's ways to avoid taxes, and there are ways to avoid taxes, specifically strategies to minimize depreciation recapture. And one of the first things you could do is you could do what's called a 1031 exchange. And you can defer taxes by doing this. It's used quite frequently by real estate investors and people that are looking to hold on to properties over their lifetime. And it allows you to defer taxes because what you can do is you can reinvest the sale proceeds into another property. The next thing you can do to try to avoid taxes is you can convert the property to a primary residence and exclude some of the gain from tax under the Section 121 exclusion. Another way you can reduce taxes is you can sell the property in a low income year. Because you'll be in a lower tax bracket, it'll reduce your tax rate on the recaptured depreciation. Another thing you can do is you can use capital losses from other investments to offset your gains. Another thing you can do is you can consider an installment sale. This can get pretty complicated, but you can spread out the tax burden over several years to help minimize the liability there. And what some people do is if you're in a good financial situation and you don't want to do anything that I just mentioned, you can also donate the property to charity to avoid depreciation recapture. Avoiding depreciation recapture entirely is super tough. These strategies that I mentioned, they can help you reduce the tax impact, but you have to remember taxes are always so complex and we have no idea what's going to happen with the tax code. So it's crucial to work with a tax professional and, in my opinion, also a CFP to figure out what's the best approach for your situation. Also, what you might be dealing with too is you might be dealing with an over concentration of real estate in your overall portfolio. So this happens a lot, and I'm seeing plenty of examples in my wealth management practice of clients that are coming in with a lot of their net worth in rental real estate. And so they're now thinking about succession planning, they're thinking about their golden years, and they're thinking about not being so responsible or having the responsibility of having these rental properties and dealing with tenants and payments and leasing companies, management companies, maintenance, repairs, taxes, all the extras that come with it. What I'm finding is clients are really trying to diversify their holdings so that they can just have a much more relaxed retirement. So in the next video, I'm going to walk you through a scenario using my financial planning software to see exactly what that looks like when a client decides to sell multiple rental properties, pay the tax, deal with depreciation recapture, and move on. So if you found this video helpful, make sure you hit that subscribe button so you don't miss out on more tips and strategies for optimizing your investments and tax planning for retirement. So thanks for watching, and I'll see you in the next video.